target and continued evidence of a restrictive labor market, the economy appears to be in a late cycle pattern. Or is it actually? Our next guest says that mid-cycle dynamics have emerged, leading to a broader economic growth globally on a global basis. So where does our next guest believe that we are today in the business cycle? And which asset classes is she feeling most positive about in this current market environment? Here today to help you take a look at the health of the global business cycle and how that could ultimately shape some of your investment decisions is Fidelity U.S. Asset Allocation Research Analyst, Cait Dourney. Great to see you here, Cait. How are you today? Glad you could join us.
Thanks so much for having me, Pamela, and happy late August to everybody.
Indeed, indeed. And is it actually, we'll invite everyone to send their questions in, but we want to ask you about this late cycle dynamic ultimately that many people have been saying this is classic. This is classic late cycle. Clearly, we've seen valuations, maybe largely for the Mag 7, but in certain places just wild. This must be the end. Is this the end of a business cycle in your mind?
There's a lot in that question. It's a hard question. And I would say the way that I would answer it is that our highest conviction view overall is that we're in an expansion. So yes, there's elements of mid-cycle, there's elements of late, and I can talk about what those are. But overall, our highest conviction view is that we're still in an economic expansion. We're still underpinned by a very solid corporate sector and consumer sector, which are two of the biggest parts of the economy. So as you mentioned, Pamela, over the last year and a half, there have been more mid-cycle dynamics that have emerged. So this has come from profit margins starting to expand. It's come from earnings going from mildly contracting to starting to grow again. I mean, earnings were up 10% in the second quarter of this year for publicly traded companies. And it's come from progress on inflation, some cooling of the labor market, some loosening of financial conditions, both market-based and the surveys that we have of bank lending. So those are all kind of mid-cycle, a little bit of disinflation, kind of better dynamics. We still are a bit tethered to late cycle where we have a still tight Fed, although likely to get less tight starting in the next couple of weeks. Still inflation we've gotten a lot of progress, but still above target. And overall kind of pressure on rate sensitive parts of the economy like housing or manufacturing. So there's kind of elements of both. You tend to always have that, but overall we do still see a pretty solid backdrop for the US.
So you do tend to always see that, as you say, there'll be elements that will point to both to an extent. But it's that question of, is it different this time? And it really comes from all the stimulus, both monetary and fiscal, that got essentially dumped into the system, is now being taken out in certain ways. But has that just sort of rocked the boat a little bit on being able to see the cycle that we're in and maybe just leading to some differing views on that?
Yeah, I think that's a really interesting point. So usually when you go, what ends a cycle is you built up all of these excesses, right? And it's just the burden of that interest cost or all the debt that you've taken on just becomes too much as the Fed raises rates and then you have a recession. It doesn't happen this time because a lot of the private sector hasn't taken on leverage. The corporate sector, whether it's financial, non-financial, the consumer sector in the US really has not taken debt up. Actually, debt levels are lower than they were 15 years ago, and we have this long-term fixed rate debt. So it really hasn't materialized the way that it normally would, which gives us conviction and the broader expansion. The way that we look at this and the way that we analyze it, we have these models that compare the economy to history, which is where we're getting that mid-cycle dynamic and the late cycle dynamic. But we also spend time looking at what's different this time, what could make the cycle longer, what could make us go back in the cycle. And that's kind of where we get to a lot of things that I just mentioned, those things that are just a little bit different this time, that we haven't followed the typical pattern that you might have seen, in past cycles.
It's so interesting. And before I ask you how we might be going forward a little bit backward in some of those things, tell us a little bit about you and your job at Fidelity and what you do on a day-to-day basis. You're obviously looking at these models and analyzing those, but just fill out the picture for us a bit.
For sure. So I cover the business cycle. I cover it for the US. Like I said, we run these models. We do a lot of work on the economy and the markets. I cover China, India, Europe, Canada, some of these other economies as well. And I also give our asset allocation recommendations to the multi-asset class portfolio managers that you see on here all the time. So we run a pilot portfolio. We are giving, regional equity views, stock bond call, within fixed income, different fixed income categories. So basically, my whole job is to look at the economy and look at the markets in order to give those active asset allocation recommendations.
Absolutely fascinating. Okay, so let's go to the U.S. economy, and then ultimately we'll start talking a little bit to some of your other parts of the job, to the relative story and U.S. exceptionals, and we'll get into that in a sec. But I'm quite curious about sort of the bifurcation of the economy that we hear about. It also is sort of one of those, I don't know if it's controversial, but there are questions on both sides of whether some parts of the economy are just doing brilliantly and others are actually struggling. What do you say to that? And how do you see that ultimately working into investment decisions? Is there a bifurcated economy at this point?
I think that's broadly true. And I think in some ways that's a good thing, right? Because it gives us all investment opportunities and we kind of want that dispersion. I would say, overall the economy is doing okay if you look narrowly at something like the profit cycle. So I mentioned, U.S. equity, publicly traded company earnings are up 10% over 10% in the second quarter. But if we will look at economy-wide earnings, so this includes small businesses, private companies, they're actually up mid-single digits after a mild contraction last year. So that's not so bad. Everybody is kind of lifted a bit relative to where they were last year. But when we look within that, we do see kind of dispersion across sectors. So at the economy level, we are seeing, still more strength in services. We all know that if anybody has traveled this summer, we're seeing that services spend in real time. Still weakness in housing, housing activity is depressed, kind of similar, similar to what we see in Canada, where there's not a lot of transacting going on. Same with manufacturing, again, another rate sensitive sector. So within the kind of the real economy side, that's where we see some differences. In terms of the equity market sectors, as I said, we've seen kind of over half of sectors starting to grow earnings again. We've seen about 60% of sectors with margins that are wider or higher than they were a year ago. So that's decently broad-based, and that's coming from kind of some of the guys you would expect, so tech or comm services, but it's also coming from utilities, to some extent financials, and also consumer discretionary and staples have started to participate as well. Still seeing some weakness in areas like REITs, areas that are more rate sensitive. So a little bit of dispersion, although I would say kind of on net, most sectors are a bit better off than they were a year ago.
And which to some people is shocking because they're very high interest rates right now, and there is an ability, it seems, for a lot of performance, even with that as the backdrop on the rates front. As you mentioned, we are expecting rates in the United States to come down starting in September. It's the consensus view. Should that fix the other stories in the economy?
I think it helps. So if we just take the two biggest kind of rate sensitive parts of the economy, housing and manufacturing, I think it helps a little bit, right? Mortgage rates in the US are now kind of just above 6, down from where they were, a couple quarters ago. So if we get a little bit more, a little bit under 6, that helps a bit and brings some buyers into the market. But as you know, we have long-term fixed rate mortgages in the US. Most people have a 30-year mortgage, and the average rate on the mortgage stock is sub 4%. So it probably brings a little bit of lift into the market, into parts of it, into things like home furnishings or other housing related in addition to housing itself. But it might not be an absolute game changer going back to sort of 2019 type levels. Same thing on manufacturing, makes it a little bit cheaper to get a loan to do some CapEx, but I think it might not be a wholesale game changer for those categories. It might just be more of kind of an incremental lift in the US.
Let's go back to some of the things when we opened up and sort of you broadly looked at the pieces of the economy that you're looking at. So the profit margin story, which has been very interesting to follow, kind of the credit story as well, and also the labor market, which we all seem to think the Fed is pretty fixated on at this point. So can we just go through those three: profit margins, credit conditions ultimately, and kind of the labor story?
For sure. So starting out with profit, the earnings cycle in the US. So last year we were in a mild contraction. Earnings were contracting sort of mid-single digit. And this year earnings are growing again. And we're seeing that in about half of sectors, as I mentioned. We are seeing it actually in kind of mid and smaller cap companies too. We're seeing rising earnings estimates, which is a good thing because we found that earnings revisions are closely correlated with equity performance. So overall, broadly good. And as I mentioned, the real economy profits are also growing somewhere mid-single digits. So that's kind of a green in a good spot. Credit conditions are still, rates are high, but they are starting to come down. We've seen banks more willing to lend really across any type of lending, whether it's lending to consumers, to businesses. And we know that, we'll talk about the Fed, but we know the Fed is likely going to be bringing down their policy rate starting in a couple of weeks. And so the credit backdrop, I would say, is the level is still relatively tight, but the change is better. And then unemployment. So this is similar to how profits were, last year contracting, this year better. Employment's a little bit of the reverse. We've had this red hot labor market for years in the US, as we have, in many parts of the world. But this year we have something different. We have a normalizing labor market. We have labor demand coming down and more normal levels. We have labor availability getting better with people coming into the labor force. And so unlike kind of last year where we had this red hot labor market, we are having this normalization, and we're all watching closely to see just how much it's going to slow or cool or normalize, or kind of choose your word of choice.
Right. Yeah, it's fascinating. And those are ultimately sort of leading you into some of the dynamics, as you mentioned, of where we are in the business cycle, all these different pieces. I might ask at this point, we'll go into kind of how you're looking at other countries, but I mean, inflation, there are those that will say inflation is still a concern, actually. And then sometimes we look at the bond market, it's preparing for a recession not too far away. So it's hard to read some of the different stories within. What is a bigger risk in your mind? Is it more inflation, which would mean stasis on the rate movement, or is it actually a recession in the offing?
It's a great question and a loaded question. And
Sorry.
we have a really strong inflation analyst, Colin Crownover, who I get to pester with questions all the time. And he has an inflation forecast of around 3%. So not really getting down to 2% anytime soon. So I would say that, combined with the fact that the Fed has now really moved their attention to the employment side of their mandate and to that risk of recession that you said, that kind of reduces the risk of recession, because the Fed's now going to be focusing on it and hopefully easing policy. That almost reduces that recessionary tail. Whereas we do think that inflation is pretty sticky and probably not heading all the way down to 2% anytime soon. So on that, on a medium kind of outlook, we would take inflation as the bigger risk.
That's a bigger risk. Tell us a little bit about how the U.S. Looks, and we'll break it down into asset classes in a minute. But I'm curious, sort of relative to other countries that are also going through their own interest rate cycles, in many cases cutting after having had heightened interest rates over the course of the last couple of years coming out of the pandemic. Is it still U.S. exceptionalism if you had to go sort of regionally?
Yeah, it's another good question. So how we look at the international cycle is 3 prongs. We look at first, we have recession probability or business cycle type models. And those are telling you that recession risks have gone down pretty much across the board internationally, relative to where they were last year. So that's better. We're seeing it the most in places like Europe, a couple of emerging markets, to a lesser extent in Canada. So that's kind of looking a bit better. Whereas the US recession likelihood has kind of been unchanged at relatively low levels. So kind of less US exceptionalism on that metric. The second thing we look at is earnings, and we look at earnings revisions, because we find that relative earnings revisions, so our EM companies getting their earnings revised, faster or slower than US, we find that is a really strong correlation with relative equity performance. On that metric, we're actually seeing some better signs for international markets too. So we're starting to, just in the last 3 months or so, see international earnings revisions in places like EFI, so developed markets, or EM actually start to outpace the US. And this has been a change because for the last 18 months, US has been the only game in town with the strongest earnings backdrop. So a little bit kind of more positive there. And then on the third one, we look more broadly at macro and we look at policy and things like that. And as you alluded to, actually, we are seeing central banks with the room or ability or willingness to cut rates to a greater extent in Europe, Canada, England, other places kind of faster than the US. So taken together, it's not a slam dunk, but kind of all three of those prongs of our approach look a little bit more favorable or kind of less negative for these non-US markets than they did if we were having this conversation, 6 months ago or a year ago.
Fascinating. So within the broad asset classes, if we're just to break it up into equities and fixed income, how does that fit with maybe a slightly different regional view? Like it used to be, as you said, US exceptionalism, but really US equities was sort of the story. To what extent is that still the story? Maybe lessened? Just sketch that for us.
For sure. So, in our recommendations or our kind of conversations that we have with portfolio managers that you guys have on this call, we've been, modestly overweight equities overall. We have had most of that exposure in US, just reflecting all the things that you and I are talking about. We do have small allocations to developed markets and to emerging markets relative to our benchmark. And it's something that we're thinking a lot about. So we kind of we've dipped our toe in that, and now that we're seeing kind of more conviction that these markets are getting a little bit better, it might make sense to take a stronger view there. It's kind of still early in the process, so that's how we're thinking about it.
Really interesting. On the fixed income side, again, is it primed for the idea that rate cuts are on the horizon in the US? They've gotten going in other countries already.
Yeah, so we have reflected that view. So we had been recommending or expressing a shorter duration than our benchmark for some time on that kind of resilient cycle view and the resilient inflation view. But then about 2 months ago now, we started recommending things like intermediate treasuries and also tips to bring us into more of a neutral duration view. And that's just because if you think about what we think drives duration, it's growth, inflation, and Fed policy. Growth is slowing, normalizing. Inflation is still slowing for now, and Fed is easing. So all those things should be on net kind of good for duration. And so that's kind of where we are kind of sitting neutral relative to our benchmark with positions in tips to reflect the inflation view and some intermediate treasuries that tend to benefit when the Fed is cutting rates.
That's fantastic. Okay, well, we'll circle back to some of those ideas. There's some great questions coming in. So let's, I think you sort of answered the cycle view. Is it only for the US? Do you want to just kind of go back over that? When you're speaking about the cycle, generally, and we're referring to that, is that the US cycle only? That's the question.
Yeah, it's been kind of all my comments were mostly about the US. We have seen that more kind of positive lift play out to a lesser extent elsewhere. So if we look at the earnings cycle or the profit cycle, we have seen now about a year after the US profit margin stabilized, we started to see margin stabilize in Europe, in Japan, Canada even, and in some emerging markets. So kind of we are seeing this lagged bit of a profit lift in the rest of the world. Same thing if you look at trailing earnings growth, we saw kind of greater earnings contractions in the rest of the world than we did in the US. And now we're starting to see those bottom out and kind of narrow those declines. So that all is true everywhere. I think what's different is the kind of lack of interest rate sensitivity is pretty unique to the US, which is why I think during the hiking cycle, the US was kind of more buffeted from that impact.
So interesting. I might just add on to that. So let's talk about Canada, because we're all sitting here trying to figure out where the interest rate story is going here, which looks like it's coming down. How much more do we need it to come down?
I mean, no one knows exactly, but I do think that Canada is a rate sensitive economy. You guys have much shorter term mortgages than we have in the US. The good thing is that you have a lot more room to bring interest rates down to some extent because there's been more progress on inflation. The Bank of Canada has expressed a willingness to really start cutting interest rates. So that's kind of how I would think about it. More room for cuts or more cuts expected in Canada than in the US. I think the ultimate growth lift is still TBD because even as the bank cuts rates are still likely to be higher than they were in 2020 or 2021, right? So it's not clear just how much of a growth lift you'll see across the board, but certainly a better backdrop than Canada was seeing last year, especially the back half of last year.
Really interesting. So up off the bottom in terms of sort of where we sit. Here's another question coming in. So any comments on the 10-year to the 2-year curve? Yeah, ultimately, let's talk about sort of the inversion, the unwind, what you've seen in that in those markets.
Yeah, it's a great question. So we've obviously seen that curve now flatten, and you would, in order to be in a normal environment, you would want that curve to steepen again. But it's been kind of inverted for so long now. Um, is there something specific about the question about the impact of the economy or the impact of the markets of this curve?
It just sort of a question of they became positive. Yeah, just any comments is actually the way it is. I mean, I guess ultimately let's go with the steepener. Like it should steepen. Do we expect
Yes.
it to steepen? What would we watch for to kind of keep an eye on that? And ultimately, I guess, does it take out the recession risk? I mean, that's sort of one of the things that you want to look for with that.
I gotcha. So yeah, I think my view would be over the next year or so, these curves should steepen. It's not normal to have an inverted or a flat yield curve, right? And we now have a Fed cutting, which helps that happen. And if we have growth hold up and inflation kind of stick around, then that may lift the long end a bit. I think as a recession indicator, it's tricky because the yield curve is a tried and true recession indicator. We have it in some of our models. But it didn't work to call a recession, right? And there's lots of reasons why we can all debate about why that is, but it didn't properly or hasn't properly signaled a recession. So it's not clear to me that if it uninverts and is positively sloped again, that means that we're in the clear. I think maybe we want to look at other things, like we want to look at the labor market, we want to look at, hiring intentions, the profit cycle, all this other stuff. Just because I think it's one indicator, we can look at it, but maybe it hasn't been as reliable this cycle. So we may want to lean a little bit more on kind of other bodies of work.
Fantastic. And you're bringing those to us, which is great. Other question coming in here. Cait, do you expect further expansion within the tech sector? It's a good question after earnings last night. Yes.
Yeah, it's a great question. So I'm not a tech analyst, so I don't know that I really have a view. I think our internal analysts at Fidelity are positive on the medium term or longer term for this sector. So I would take them. They're the experts.
Perfect. So let's come a little bit back to, you mentioned actually India is an area that you cover as well. It's had a gangbusters equity story for some time. Let's talk a little bit about the US dollar, maybe where investors want to go if you do or don't see weakening. Let's talk a bit about the dollar and then ultimately what it means for the rest of the world in terms of investing.
Definitely. So our great inflation analyst that I mentioned, he also covers foreign exchange, and he's had a view that over the longer term, the dollar should weaken for the reasons that we all kind of know. Inflation, or I'm sorry, not inflation. US exceptionalism should fade. It can't last forever. Deficit eventually might have an impact. So over the medium term, we would expect the dollar to weaken from these, very rich levels relative to history. Generally, that is a good thing for global growth. It's a good thing for global financial conditions. Everybody kind of gets to breathe generally a sigh of relief when the dollar starts to weaken. In terms of where money might go, I mean, yes, historically, when the dollar weakens, money flows into places like emerging markets, more sort of higher yielding credit instruments. And so we could expect all that to happen, especially if US growth is still generally holding up as we expect. The other thing that's happening too is money is to some extent flowing back into domestic markets. So foreign investors like the Japanese investor, we spend a lot of time going to Japan, meeting with investors there. They're as Japanese yields have gone up, they've started to take money home and invest domestically as well. So that's our view on the direction of the dollar over the medium term and some of the knock-on effects. The dollar's been rich for a long time, so calling that inflection point, I think, is hard to do. But that would be kind of our longer term kind of portfolio view.
Is there anything else on terms of expansion from where we go here? So we've got earnings in for Q2. There's lots of questions about sort of where we go for the second half of the year. There are questions about the US election and what that means for the economy one way or the other, but really the Fed story is there and what happens from here. What sort of broadly do you sketch out for the second half of this year? Do we see a lot happen, or in fact is it just kind of waiting for these rate cuts to kick in?
Yeah, I think it's going to be an exciting second half of the year. I think we're going to have some Fed cuts. We have, all market participants and investors are looking and overanalyzing, every jobs data that comes out. So I think it's going to be an exciting time. The other thing that I think is going to matter is, the Fed is bringing policy rates down. So it's bringing cash rates and money market rates down. There's a lot of money sitting in money market funds in the US. Now that those money market investments aren't as attractive, right? So there may be people that, as the Fed is cutting rates, their investors are more, looking for a yield elsewhere or looking for something elsewhere if they're no longer going to be getting 5% on their cash. So that could go into other parts of the fixed income market. It could go more broadly into non-US equity.
Like,
yeah, yes.
So that would be, okay, really interesting. And I mean, in terms of the equity market broadening story, is that something that you can comment on? Just, I mean, it was a truly bifurcated market. There's been broadening. There's a small cap story that seems to be working its way through much of the discussion and certain types of consensus. What do you see on kind of the equities side of things? The broadening story is really the question. Is that something that you see?
Yeah, we do see some evidence of that happening. So we see some evidence in broadening in fundamentals. So those earnings revisions that I talked about, they're now starting to get more positive for all these non-US regions, for mid cap, to a lesser extent for small cap. And so because we believe that stocks ultimately follow fundamentals, that kind of fundamental broadening, we do think could provoke some broadening in performance as well. The other thing is that as the Fed brings rates down, it should give somewhat of a lift to these more interest rate kind of equity type categories, which could allow for some broadening as well. So we're kind of looking for it. It's just early evidence at this point, but we do think that there is some fundamental backing for that happening over the next 6-12 months.
And from sort of a risk perspective, are there less, I mean, we've been talking about this through a few different discussions over the last week or so, but is there really a Fed put? And this is almost a Fed put in another way than what we meant 10 years ago, for instance, but the idea that the Fed has quite a lot of levers to pull if needed.
I think so. And I think we've heard that from the Fed. We heard it from Powell at Jackson Hole last Friday. I mean, the Fed has expressly said, that the risks have gone now down from only on inflation to balanced. Now they're talking about downside risks to the labor market. And the good thing is that the Fed has quite a bit of room to cut rates. They're 200 bips or so above their estimate of neutral. They've brought inflation down. It's not 2%, but it's 2.5 on core PCE. They're getting closer. And while we don't think it's going to go all the way to 2, that's kind of enough progress up to this point to justify cuts. And so to us, in a lot of ways, this is a safer, better backdrop than we were in say early 2022 when policy rates were 0 and inflation was 6, right? We're in a better place now. And that, I think that put is on the table and kind of should give us all a little bit of, a little bit of relief.
And it also points to, as you mentioned at the beginning, the idea of expansion. The business cycle has expansion within. If you want to just sort of repeat a little bit how we began that on where we are in the cycle.
Yes. So just to wrap up, our highest conviction view is that we're still in an expansion. When we look across the profit cycle, which is things are still healthy and actually getting better sequentially, the credit cycle where things are getting incrementally easier on the bank side, capital market side, monetary policy side, and then the employment cycle is broadly normalizing. All these things are supportive to just an ongoing expansion. And the fact that the Fed has become more attuned to the risk to the employment side, I think, increases the likelihood that we can continue to have expansion because they're paying close attention to those risks.
Cait Dourney, it's a pleasure to speak with you, and thank you so much for joining us on Fidelity Connects.
Thank you. I appreciate it. Have a great
Yeah.